Okay, the time is now 1:30 CE time, and I, Torben Johansen from FSR Danish Auditors, will welcome you here to this EFRAG and IASB outreach on the discussion paper regarding business combination disclosures and goodwill and impairment. And also very welcome to the members from IASB and the members from EFRAG. And thank you for participating in this outreach, in this web meeting. Hopefully we can get some very good views and inputs from participants. And I'm also looking forward to the views from both IASB and EFRAG on these very important topics from this discussion paper. So hopefully we can get a good debate and some very good inputs and views on these topics that we have set out in the agenda for today. So again, very warm welcome to all of you, and I will hand the microphone over to you, Kristian.
Thank you very much, Torben, and also a very warm welcome here from Copenhagen. I'm sitting here with Jan Peter Larsen next to me, and we will be moderating the session today. I have to say we are very honored to have both the IASB and EFRAG on this outreach. I think it demonstrates the true importance and also the collaboration that we are experiencing in these matters, and that is, at least from our point of view, very beneficial to drive best accounting practices, good accounting practices. Following the presentations by both IASB and EFRAG, we have a few panelists that will join us live from the prepare and regulatory side. But I have to say we would urge you and really welcome you to pose questions on the chat function when that opens, because that is the only way that we can ensure a lively debate on today's event. As it was highlighted, we believe this is a very important topic. It has been around for a number of years, and some of the questions have been debated previously. But we think it's a good discussion paper, and we're really looking forward to having the discussions today. Before we hand over to the presentation from the IASB side, I'll hand over the floor to Rasmus from EFRAG, who will talk about some of the practical issues on today's event.
Yes, thank you. Yeah, I will just mention that under this video, you will see a box in which you can submit your questions and comments during the webinar. If you do not see the box, please refresh your screen and the box should then appear. And also under the box where you can raise your questions, you will find the presentation used today and a presentation of the speakers. To the right of the video, you will sometimes see some polling questions, and we encourage you to reply to these questions as your views are important for us and as it would make the discussion livelier. The first question for you is about your background, and please provide your answer and submit the answer to us. While you answer, I will hand back to Jan Peter and Kristian.
Thank you, Rasmus. It's still moving a bit, but it seems that we are well distributed among preparers, accountancy profession users, and regulators and others. So I think we have a good mixture of participants here.
So with that good diversity in terms of backgrounds, I suppose with a slight overweight of the accountancy profession, but it's good that we have a broad distribution. Let's go and let's have a look on the agenda for today. If we could have the next slide. We have tried to distribute today's topic into 3 key topics, as was also indicated in the invitation. We'll have an introduction to the exposure draft by Tom Scott and Paolo Dragone from the IASB, and followed by EFRAG's view on the topic by Chiara del Prete. If we look on the presenters today, on the next slide, As I indicated, we are honored to have a board member from the IASB. And Tom Scott, you will have the opportunity in a moment to introduce yourself. Then we have from the EFRAG also a strong team with EFRAG Tech Chairwoman, Chiara Prete. I'm awful at names. You'll probably learn that and experience that as we go. We have Kathrin Schöne, EFRAG Project Director, and Rasmus, that you've already encountered in the introduction here, Senior Technical Manager. So we have a strong team from both EFRAG and IASB board side. From our side, on the next slide, Torben Johansen did the introduction, Chairman of the Danish DASC.
Danish Accounting Standards Committee.
Precisely. That was the vice chair of the Danish Accounting Standards Committee, Jan Peter Larsen, that spoke, and myself, Kristian Koktvedgaard, with the Confederation of Danish Industry. So, without further, let's go to the next point on the agenda, namely the introduction of the IASB exposure draft. And I'll hand over the floor to Tom Scott from the IASB. So, Tom Scott, welcome.
Thank you. Thank you very much. Good morning, everyone. Thank you for attending this event, and thank you to the FSR and the Confederation of Danish Industry for inviting us. We're delighted to be here along with our colleagues at EFRAG. So if we could just go on to the next slide, please. Yeah, so we always have a little bit of housekeeping. As with all our presentations, any views we express today are our own views and may not necessarily be shared by the rest of the International Accounting Standards Board or the IFRS Foundation. That applies to anything I say or that Paolo says. We'll be handling the bulk of the presentation, and we also have a new board member with us as well, Zachary Gast. So the next item, please. So this is an important set of proposals for the IASB. Investors are keen to receive better information about acquisitions, both at the time that acquisitions are made and to understand subsequent performance. As many of you know, the thorny question of subsequent accounting for goodwill is one that has been of interest for many years and tends to give rise to polarized opinions. Questions have also been raised about the effectiveness of, as well as the complexity of impairment testing for goodwill. In particular, many are concerned with the timeliness of the recognition of impairment. So if we could go next to the, apologize, no, stay where we are. So this slide provides an overview of the project, business combinations, disclosures, goodwill, and impairment. The IASB started this after a post-implementation review of IFRS 3 business combinations. We published the discussion paper in March. The deadline for submitting comment letters has been extended to the 31st of December 2020 because of the strain the coronavirus is placing on stakeholders. While many have focused on the accounting for goodwill aspect of the project, the objective of the project is much broader. The objective is to improve the information that companies provide to users of financial statements at a reasonable cost about the businesses those companies buy. The IASB plans to provide investors with better information about business acquisitions that should help investors in making investment decisions and to hold management to account for those acquisition decisions. The discussion paper contains a number of specific questions for stakeholders. The IASB is particularly interested in hearing from stakeholders on how useful and feasible they think the new disclosure ideas are, as well as whether they have any new evidence or arguments on the best way to account for goodwill. So we go to the next slide, please. This slide summarizes the IASB's preliminary views that are presented in the discussion paper. The preliminary views cover three main areas and reflect concerns the IASB heard from stakeholders. The first area relates to disclosures. The IASB's preliminary view proposes that it should require companies to disclose information about how business combinations perform after the acquisition. The second area relates to improving the accounting for goodwill. The IASB explored whether it could make the impairment test more effective, but its preliminary view is that it is not feasible to improve the test significantly at a reasonable cost. The IASB then considered whether to propose reintroducing amortization, and the IASB's preliminary view is that it should not do so, because there is no compelling evidence that doing so would significantly improve financial reporting. Finally, the IASB explored some possible simplifications that would reduce the cost of performing the impairment test by removing the requirement to perform the test annually and amending how value in use is estimated. The third and final area relates to some other topics. The IASB's preliminary view is that it should require companies to present total equity excluding goodwill on the balance sheet. The IASB also thinks it should retain the current approach of requiring companies to recognize identifiable intangible assets separately upon acquisition, rather than subsume some of these intangible assets into goodwill. We will only be discussing selected topics from the discussion paper today. However, we have included a few slides in the appendix that cover the other topics from the discussion paper. It is worth emphasizing that the views in the discussion paper are preliminary. Depending on the feedback and comments that the IASB receives from outreach, events such as the one today, and comment letters, the IASB may decide to reconsider some or all of these preliminary views. So I now turn the microphone over to Chiara.
Thank you, Tom. Can we go to the next slide? First of all, good morning to all of you. And on behalf of EFRAG, I'm pleased to have organized this event, which is the second of these 2020 joint IFRAG and IASB outreach season undertaken in cooperation with the Confederation of Danish Industry and Danish Auditors after the successful event on PFS. So in terms of introductory remarks to EFRAG position, goodwill is a relevant topic for us. It was in our research agenda already from 2015 to 2018 before the IASB started the project, and we're pleased to see that this DP has also taken on board some of the detailed proposals from our thinking in those papers. EFRAG mission in this phase is to develop a European position on the paper to convey to the IASB. So that's why views from all interested European stakeholders matter for us. We issued the draft comment letter the 29th of May. Our comment period ends 1 month before that of the IASB because we have a long due process in front of us before we issue the final letter. You may find on our website both the link to comment on the comment letter, but also to a survey dedicated to preparers to have their feedback on the proposals in the DP. There is still time to participate, so we would welcome preparers to provide their views to us. In terms of position, we support the objectives of the discussion paper, and we agree that there is a problem with the information that users currently get about goodwill and performance of an acquisition. So we broadly support the disclosure proposed approach. However, we have identified a number of concerns, and we question the location in the financial statements, but we will discover more in the next sessions that we have in a minute. However, we also note that this disclosure serves primarily the need to understand how a business combination is performing, while there is not a direct linkage on the recoverability of goodwill on balance sheet. And we know that this is part of the problem. Users say that the reported goodwill has limited relevance for several reasons, including that the goodwill is a mixture of different components, including that the impairment test is affected by the so-called shielding effects, and is not tested directly but indirectly through the test of the CGU to which it is allocated. So we think that there are issues in the current accounting for goodwill. Now, we note that the IASB proposal consider not possible to develop a more efficient test and addresses the issues mainly through disclosure. But we think that there is room for improvement, and we will see in detail in this presentation what we are proposing to the IASB to consider without major changes to the approach, but to make it more effective in practice. We are also consulting on a number of other issues, including whether there is new evidence to support possible reintroduction of amortization. We don't have at this stage a final position on that. So with this, I hand over to you for the next sessions.
Thank you very much, Chiara. So with this general introduction, and I mean, it's no secret that we have followed the topics as well with great intensity and interest. Let's try to dig down into one of the topics, namely the first topic on the agenda, the disclosure about business combinations. So I'll hand the floor back to the IASB. I don't know, Tom, will you start on topic one?
Paolo will be doing the presentations.
Thank you and good afternoon to everybody. We can move to slide 13. Thank you. We'll look now at the first of the topics we will discuss today, the IASB's preliminary view on improving disclosures about acquisitions. One of the key messages that the IASB has heard from investors is that companies generally do not disclose sufficient information to allow investors to assess how well a business combination has performed post-acquisition. Investors want this information to hold management to account for its decision to acquire those businesses. Most investors told us that the information is needed for stewardship purposes to help them, for example, determine whether they can trust management with future capital. Existing standards do not specifically require companies to disclose such information, and hence, any information that is provided today is disclosed voluntarily. Therefore, the discussion paper explores whether to require companies to disclose information on subsequent performance of business combinations. The IASB's preliminary view is that it should require companies to disclose in the year of acquisition, firstly, the strategic rationale for the business combination. The rationale will be a high-level statement that links the business combination to the entity's overall strategy. Secondly, the key objectives of the specific business combination, these being the more detailed aims that management intends to achieve as a result of the business combination. And thirdly, the metrics and targets that management will use to assess to what extent those key objectives are being achieved. Then, in subsequent periods, the company will disclose the business combination's actual performance based on those metrics to enable users of financial statement to assess to what extent the key objective identified at acquisition date are being achieved. So, what kind of information do company needs to disclose in the subsequent year? Slide 14 look at that question. There is a wide range of business combination and they serve a wide range of purposes. So the IASB concluded that no single metric will be suitable for every business combination. Therefore, the IASB is exploring a management approach. In other words, the metric disclosed will be those an entity's management uses internally to monitor whether they have met the objective of the acquisition. Such measures could be operational or financial or a mixture of both. But because acquisition can involve a large sums of money, the IASB presumes that most companies are monitoring the major acquisitions. But if management is not monitoring a business combination, the IASB believes that the company should disclose this fact rather than the IASB prescribe a minimum set of information to be disclosed. And when we say the information being used by management, what do we mean? The discussion paper proposes that we use the perspective of a company's chief operating decision maker, which is a term that is used to identify the disclosures required for segment reporting under IFRS 8. The main reason why the IASB is suggesting using the CODM as a threshold in this new context is so that companies disclose the most important information about the most important business combinations. A lower threshold might result in excessive and costly disclosures, particularly for companies that make many acquisitions. One thing that the IASB will like stakeholders' views on is whether using the CODM as a threshold will lead to companies disclosing all the material information that investors need about the business combinations they want to know about. The IASB is aware that some stakeholders have various concerns about providing this information. For example, what if the acquired business is integrated with an existing part of the business post-acquisition? The answer to this depends on how management is monitoring the success of the business combination. For example, the CODM may be monitoring the performance of a business combination using information about the combined business rather than the acquired business in isolation. In that case, the company will disclose information on those metrics about the combined business that the CODM is using. The principle here is to disclose the information that management uses internally. The IASB is not expecting companies to create disclosures to satisfy the requirements, but to disclose the information that management are already using internally. Sometimes, when we discuss the board's preliminary view on subsequent performance disclosures, the issue of integration is raised, and it sometimes sounds like it prevents company from monitoring the business combination. And so therefore, when integration occurs, management do not know how well a business combination is performing. However, when we have the opportunity to discuss this with the stakeholders, we often find that management are still monitoring the business combination in some manner and are aware how well a business combination is performing, at least in early years, as the IASB expected. The discussion paper discusses other concerns that the IASB has heard, including whether this information is commercially sensitive and whether it's verifiable. The IASB wants to explore these concerns with stakeholders and hopes stakeholders raising these issues will also help the IASB find ways to address them. Since, in the IASB's view, it's reasonable for users of financial statements to ask for companies to provide information that will help them understand better how a business combination is performing. In short, a plea to help us to work something out that works for preparers and help investors, as this is an area which is very important for investors. One final point to make on the subsequent performance disclosures is that some stakeholders have said that the board is asking for information of a type that should be included in the management commentary rather than in the financial statement. Because, for example, it's strategic, it's a management view, or it could involve non-GAAP measures. However, the conceptual framework is not a barrier to including such information in financial statements. And investors have said that they are not getting enough information today on subsequent performance of acquisition, there being no requirement in IFRS to provide this information, and therefore, any information investors are getting today is being provided voluntarily by companies. In determining its preliminary view, the board put weight on ensuring the information is made available to all investors. The IASB would like to hear from those stakeholders who think this information should be included in the management commentary, for example, how companies can be encouraged to provide this information. We can now move to the next slide that summarizes the IASB's preliminary views on some other target improvements to existing disclosures included in IFRS 3. These proposals are about information provided in the year of acquisition, which include requiring the disclosure of expected synergies, defined pension liabilities and debt assumed, as well as some changes to the actual and pro forma information disclosed about the acquiree. So with this, I hand over to you.
Thank you, and then I can continue on the next slide with EFRAG's preliminary views. And as it appears from this slide 16, EFRAG's preliminary view is that most, but not all, of the proposed disclosures in the IASB's discussion paper in principle would be useful. However, as it appears on the next slide, slide 17. EFRAG notes that the proposals are related to business combinations and as such do not solve the issues related to goodwill accounting. In its draft comment letter, EFRAG notes that it could have been beneficial if the information on the success of an acquisition, in the case that it would involve a substantial amount of goodwill, could also be used to assess the reported goodwill figures. If the objectives of an acquisition would not be met, this could indicate that the acquired goodwill would be impaired, but because of the shielding effect, an impairment loss might not be recognized. However, the approach suggested in the discussion paper will not be particularly useful for this purpose, as information would only be provided to the extent that it is used to monitor the acquisition by the management. Nevertheless, a side effect of the proposal could be that the level at which an acquisition is monitored would be an indication of the level at which goodwill should be tested for impairment. EFRAG disagrees with the proposals that the disclosures on the objectives of an acquisition and whether these have been met should be based on what the chief operating decision maker monitors. EFRAG tentatively considers that the information should be based on what is monitored at a lower level. EFRAG questions the reliability of the information related to the objectives of an acquisition and the synergies, and acknowledges that some consider the information to be difficult to audit. EFRAG accordingly questions whether the resulting benefits would outweigh the costs. EFRAG has not yet formed a view and is consulting its constituents on whether it is practical and appropriate to disclose the proposed information in the financial statements instead of providing the information as part of the management commentary, as the information is based on what management expects and refers to non-GAAP indicators. And then some specific comments. EFRAG's tentative view is that an entity would have to disclose if it stops monitoring an acquisition within 3 years instead of the 2 years proposed in the discussion paper. And EFRAG does not consider that the proposed requirement to also provide pro forma information on cash flows from operating activities would result in particularly useful information. On the next slide, slide 18, you can see that EFRAG is concerned that the proposed disclosures might require entities to present commercial sensitive information. And EFRAG accordingly supports that the IASB is doing further activities to understand this issue. EFRAG is thus interested in learning whether preparers assess that the proposals would mean that they would have to disclose commercial sensitive information. As mentioned, EFRAG is also uncertain whether the disclosures would be better placed in the management commentary. Some users EFRAG has spoken with have been of the view that the information should be presented in the financial statements, as they consider the information to be important. However, some other stakeholders have noted that the information is forward-looking and as such is better placed in the management commentary. In addition to learning about operational implications of the discussion paper's proposals, its cost and the expected reliability of the information, EFRAG is also interested in learning about any constraints within jurisdictions that would conflict with the suggestions. And then in relation to the pro forma information, EFRAG notes that the manner in which business combinations are accounted for is disruptive for analysts' trend analysis. For example, when inventory is remeasured at fair value following the purchase price allocation, profit margins after the acquisition will not anymore reflect an estimate of the entity's future profit margins. EFRAG observes that alternative performance measures are used to eliminate from operating profit the impact of the effect of the purchase price allocation. EFRAG has therefore considered whether it would be more useful to present further modified figures than operating profit before acquisition-related transaction and integration costs. In addition to excluding acquisition-related transaction and integration costs, such a figure could also exclude the effects of the revaluation to fair value. Although EFRAG considers such figures to be useful, it is unsure how costly they would be to prepare. Accordingly, EFRAG is consulting on this issue. And finally, EFRAG is interested in understanding how users would react to information that an entity is not monitoring a significant acquisition, and in input on whether any of the current disclosure requirements in IFRS 3 could be removed without depriving investors of material information. So thank you for this, and I will hand back to Kristian and Jan Peter for the discussion.
You are on mute.
It's better now. Sorry, a slight delay on the computer. Thank you for these two presentations. For our point of view, these two presentations alone demonstrate the fact that it is not a straightforward issue. And just the, I wouldn't say disagreement, but the different perspectives posed by EFRAG and IASB is by itself very interesting. I'll hand over the floor first to Carsten Just Andersen from Arla, a preparer, to maybe give a perspective from the preparer side and how does this work. And my guess would be that one of the essential points is about the integration and whether you are at all able to monitor. So Carsten, the floor is yours.
Yeah. First of all, I'd like to say that in my view, we are already now providing rather detailed information on business acquisitions. And I would prefer, instead of coming with additional disclosure requirements, that perhaps it is instead enforced as either recommendations or guidelines. Talking about how we disclose and follow up on business acquisitions today, often these are focused or based on or motivated based on synergies, and I'll be careful to ask preparers to come with details, information on these synergies, as this could harm the way these are implemented. So examples could be that a business case is dependent on doing certain restructuring or reorganizations, and that would motivate the synergies. The execution of these could be harmed if we were to provide disclosures on these plans. Also, as it was said, if there are commercial critical disclosure are asked for, this could harm our position against either competitors or future negotiation with potential targets for acquisitions. I agree on viewing on how we will disclose or follow up on transactions afterwards. Often the ambition is to try to integrate an acquired business as soon as possible, and thereby it becomes difficult to track what is the acquired business and what was the original business. And thereby hard to follow up on the specific acquisition and the effect of this. But in some areas, it could make sense if you either acquire a new trademark or a new line of business. There it would be easier to follow up on how it's performing. Then the last thing I'd like to comment on is where to disclose this. I prefer this to have this in the management commentary, to perhaps have the disclosure a little more flexible and being able to set it or describe it in the right context instead of having it in the financial part of the annual report.
Thank you, Carsten, and some interesting views, especially around the issue about how fast do you actually integrate the business, and your point on synergies and whether detailed disclosures on synergies may actually harm or remove some of the potential for the synergies. I could imagine the fact that if you, as an employee, read some of the execution plans before they were actually announced, that might have an effect just on how your employees would look on the business combination. Before giving the EFRAG and the IASB an opportunity to respond back, I'll just hand over the floor as well to Lone Bregendal, that is with us from ESS. She will not join by video, but by audio. So Lone, the floor is yours.
Thank you, Kristian. Hello and good afternoon, everybody. Yes, I'm from ISS, and I fully support what has just been shared. For ISS, it would be very costly, for not say even impossible, to monitor the performance of a specific acquisition, since the main purpose usually are to harvest on synergies and especially cross sales opportunities. So to us, quick integration, quick and full integration is key. And secondly, I also support the view that sharing this kind of information on the performance on a specific acquisition would be highly sensitive information, both from the integration point of view, but also commercially. So yeah. So that's my point of view. But I fully agree that if it is going to be a disclosure requirement, then also I think that it should be made in the management commentary instead of in the financial statements. So it will be more flexible information that we can share.
Thank you, Lone, and thank you for providing some insights into how the preparer community thinks on these issues. If I take the last point first in terms of the location of the disclosures, the management commentary versus disclosure section, I understand, of course, that there's an issue if I look at the IASB side on where can you actually set requirements on disclosures. Looking at it from a European side, maybe we have more broader possibilities. But I don't know whether there's any reactions on from I suppose first the IASB side on the issue, for instance, on location of the disclosures. And also whether you understand the rationale, but then also potentially have some limitations in how you look at this. And before handing the floor over to IASB, please use the Q&A box, the ask questions box, so that we can get some input as well from the audience that is not joining live. So over to, is it you, Tom, that will take that?
I can answer. I can give you some details about the topic on the location of the information. Currently, those companies who already provide this information, they do that basically on a voluntary basis, and the feedback from investors is that they are not receiving enough information. They are not receiving this information every time. If it was based on if the requirement was just about the management commentary, that will be in the practice statement, which is not compulsory and which will be still on a voluntary basis. So it wouldn't change much. There wouldn't be a big difference from today. So that's why the board's preliminary view is to require the information to be disclosed in the financial statement.
Any reaction on that from the EFRAG side?
I think Paolo is on mute.
What's Paolo taking?
Yes, well, we on the location we don't have yet a position because we want to consult with constituents before taking a firm position. There is a clear advantage in having the information in the notes, which is the quality, the auditability, the fact that it is subject to audit, and also the comparability, because all the entities are required to present the same content. And so we understand the proposal of the IASB. But from the other side, the information is mainly forward-looking, and it has to be necessarily through the eyes of the management, because as also Paolo was saying, it's pretty difficult to identify one size fit all for the different business combinations. All the business combinations may have different targets to be monitored, different rationale. So management commentary would be better from this point of view. So we are very keen in understanding the views from the various jurisdictions where they are.
Thank you, Chiara. I think at least within Europe it is a relevant question whether you can put that information in the management commentary or it has to be in the financial statements, because we may also, when we get closer, get the questions about the auditability of the information, whether it's better placed in the management report where we do not need to audit the information but need to give a statement on whether it's coherent what is in the financial statement. But that is for a later debate. I think one question that I maybe also could ask out to both the audience and maybe also to the IASB is you have in the discussion paper proposing that the chief operating decision maker is the right level to point at for monitoring this information, and it may be so. But I was just wondering if it is an idea to perform some field testing that the information that is then actually monitored by the CUDM also meets the requirement of the users or the investors' needs when they have been asking for information, in order not to suggest something that then maybe does not meet the expectation.
I don't know who wants to comment on that.
I can comment on that. Yes, if your question is, are we planning a field work? Yes, we are. Clearly, here the point is to find the right balance between the disclosure to be provided to users and the cost for preparers. So the field work will be. We are conducting a field work, and the results, on the basis of the results of the field work, we'll see next steps.
Thank you. In terms of monitoring performance, which I think is one of the key issues that is also raised, and I mean, one of the points that we just heard from the preparer side is the fact that one try to integrate as soon as possible the acquisitions. Do we have anything essentially to monitor? We've got a few questions as well from the audience, and thank.
It's Tom. I was wondering if I could comment on the integration. We addressed that quite directly. It's Tom Scott. We addressed the integration question directly, and we expected that in many cases entities would want to bring something in and integrate it tightly and subsume it into operations of some segment. And we specifically say that if that's their intent, then what they can monitor is the combined entity. So in that case, if an entity pays a price, plans to bring it in, we presume they'd have some expectation about how that combined entity would perform that would justify the price that they paid. And it's totally their choice if they want to report on the combined entity as opposed to the entity that's just being brought in an isolated way. So I find it hard to understand when, to some degree, and perhaps they can elaborate, why reporting on a combined entity would be so difficult, as long as you plan to do it from the start. And so I don't know, maybe people could elaborate on that, because we hear that often, but we did try and address it in the discussion paper.
Thank you. Carsten, I don't know whether you would like to comment on that.
Yeah, I would more see that would follow our normal reporting on our performance, so not calling out this specific area for the acquired or combined entities. I think from a stakeholder perspective, it must be more interesting to track what's happening in the general business and the different business areas, instead of focusing on a specific part where you have done an acquisition.
Thank you. I mean, some of the questions from the audience ask a little bit about further looking into the disclosure requirements. I mean, I do understand the fact that Tom Scott raised that you can report or report on the combined entity. My guess is that if you have a lot of acquisitions, wouldn't you then end up with simply one reporting? And that might be the right approach to it, because essentially then all the small acquisitions should be integrated. And is that the right way of looking at it? Is that the what is in the proposal, if I understand it right, Tom, that if you have a strategy that you integrate, you end up with one reporting, essentially? Let me
be clear. So I use the word entity. That's a bad word. I apologize. So you would integrate it into some unit of your organization. So you would report on that combined unit, but it wouldn't be your whole company. It could be the whole company, but typically one would not expect that. So just so the point is that if you plan to integrate it with, say you have 3 divisions, and you plan to take this new thing and put it into division C, then you would report on the combined C. If you had, perhaps you did 2, what you said is quite possible though. If you took over 2 entities and put them both into C, you could then report on the combination of C plus the 2 entities. So that we understood that companies need to integrate. In fact, where would the synergies come if there wasn't some integration? So we, from the start, always accepted that, and that's why one of the reasons we went to the management view. I think certainly, just in what Carsten said, users are interested in a lot of things, and certainly they're interested in the overall company performance, and they'll still be interested in the segment performance. But they tell us they would, at least for a period of time, like to understand how when the company does an acquisition, how well the acquisition is performing in the context of those other things. That they're not as interested in especially significant acquisitions. And the last thing I'd say, it goes a little bit to the CODM about trying to stick to clearly material acquisitions and not having these disclosures for every possible acquisition that might occur. So I don't know, Paolo may want to add something, but.
No, Tom, I completely agree with you. You've said everything about that. Thank you.
Thank you. I think we can try. There's There's two questions circulating around the same topic here. Is whether the new disclosure requirement putting a lot of pressure on the preparers, the synergies, performance as such, and commercial sensitivity, etc., and will it not lead to standardized comments that will ultimately not add very much to the analysts? I think the question goes to IASB.
I don't know. Paolo, do you want to do this, or you want me to take a crack first?
Oh, yes,
take a crack
please.
First? Okay, yep. I'll do it first. I think one of the reasons we want the management point of view is exactly to avoid some standardized thing that will be the same for every company. Secondly, every acquisition is different as to why the company chooses to do it. There are many, many reasons, and there are even in the literature, you get classes of descriptions of types of acquisitions for people who want to read that. So we think that we do want management to give their view. The second thing I'd remind people a little bit just here is that IFRS 3 currently has a lot of disclosures about a major acquisition. And they do it because there is a price sitting in the background. This isn't simply people making up stuff and thinking about the future. They paid real money, and in most cases, it's pretty objective, the price that's paid. There's a little bit of measurement issue there. And so you've got an anchor. There are only a limited set of assumptions that could fit into the history of that price and still make economic sense. And so I think it's important to remember that what people are going to look at are the assumptions that justify the price, right? Because that's the thing that investors really care about. Are you good at doing acquisitions? Do you have a good process? And I think it's really important that almost all these assumptions are in some sense anchored in the price. And when I look at, if I go and look at most regulated capital markets, the meeting that would approve such a thing, there is a lot of information goes out there. In many cases, when I go and read one of these things, they're 150 pages. There's a lot beyond what we're asking. And so we're focusing on that information that is in some sense there because it should be linked to that price. That's what we're talking about, is what is happening at the acquisition.
Rasmus?
I would just add that the concern expressed by one of the persons in the audience is also something that we would like to investigate further during the next months during our outreach activities. We are conducting interviews with entities, and of course what we would have to assess is that if companies are required to disclose this information and think that some of it would be commercial sensitive, is if they would only disclose part of the truth and leave the commercial part of the truth out, and whether this would then result in useful information for the users of financial statements. So it is something that we will try to investigate further in the coming month.
Thank you. One question that Tom Scott's talked about the assumptions that justify the price. We have received a few questions a little bit along those lines. One asking whether there is any research available that show to the extent to which companies are monitoring performance, and if that is the case, then for how long? And another line of question that says that around 30% of all business combinations globally, they are not performing as expected. So the question is really, do we have any monitoring of that? And I don't know whether the IASB would like to start then, or whether Chiara would like to answer that part. Tom, you're muted if you're trying to speak.
Paolo, I will say that as part of our field work, we are getting feedback on companies, how they are able to monitor, and in general, from our field work, those companies claim that they do in fact monitor. I think also one would expect, if you have paid hundreds of millions of dollars or something for an acquisition, that you would simply not monitor. Seems to me to be not. Perhaps there are circumstances, but in general, I would expect most entities to at least monitor for a reasonable period of time if they're laying out that kind of money, if only to make sure that their processes they have in place when they do an acquisition to improve those processes. Just on empirics, it's an interesting thing, but over a long period of time, most people know that if you check returns of the acquirer around the date of the acquisition, on average, it's kind of a zero NPV. They kind of get the cost of capital, which is fine. That's what they're supposed to be doing. But there's a high range around it. Some do better, some do worse. So it's certainly a place that investors would be interested in, to understand that variance around what's happening at the acquisition in terms of generating positive returns for the acquirer or shareholders.
If I may add just one point on that, is arguably we expect that there will be a sort of market discipline if a very important acquisition is not monitored. And the proposal is also to disclose if an acquisition is not monitored.
Thank you. Any comments from the EFRAG side?
Yes. I don't know if we can look at the two purposes, one being the understanding of the performance of a business combination, and the other being understanding whether the price paid for the synergies and the goodwill recognized is at the end still recoverable. I don't know if these two objectives can really be decoupled one from the other in this standard setting process. So at least this is what we also say in our comment letter. Asking to disclose whether a business combination is performing well, yes or not, and if these numbers, 70% do not perform as expected, are correct, it's clearly a price-sensitive information. So there is a lot of sensitivity around that. But looking at the linkage with the recoverability of the goodwill, what we are suggesting is that this new disclosure it may offer an anchor point for the monitoring of the goodwill and for the definition of the correct level for the allocation of the goodwill. So we perfectly understand that there is a time after which the target acquired doesn't exist anymore, but it exists a combination of assets, liabilities, productive factors, which is conventionally called CGU. And indeed, what we wonder in our letter is also how the users will take and will react to the information which is required also in the discussion paper to disclose that the entity has stopped monitoring as a given metrics or acquisition because they have completed the integration. So question is whether the users will react, and from initial conversations with users, it seems that they will react as a sort of implicit trigger for impairment of the goodwill.
Thank you, Chiara. We're going to circle back to the specificities around the impairment test in the next topic. But I know that we have a few questions, or polling questions, at least for the audience. And Jan Peter?
Yeah, so I'll just read them out and then they will appear on your screen shortly. So First question is, will the IASB's proposed disclosure of management objective for an acquisition and subsequent disclosure about whether an acquisition is meeting those objectives provide useful information to assess management stewardship? And the options you have here is A, yes, B, yes, but the cost of preparing this information would outweigh its benefits. C, in principle, yes, but due to completeness, reliability, the ability to provide the information, in practice, the information in many cases will not be particularly useful. D, no, this information would not be useful to users of financial statement as it is not linked to accounting for goodwill. And E, no, for other reasons. And what you may see is just A, B, and C here, but then you have to scroll down on your, yes, you scroll down and then you see the questions.
And I mean, we've grouped this question together with the other question about the CDOM, or whether that is actually the right level. So we do hope that you're going to.
Yeah. So while you're working with the other question, I will just read that question. The IASB proposed to provide information, strategic, rational objectives of an acquisition and subsequent performance based on the information to the entity's chief operating decision maker, board of directors or similar, also called CODM, an expression you know from IFRS 8, as segment information that the CODM monitors. Do you think it is the right level? A, yes, this should provide the information that users want. B, yes, this is the pragmatic approach, balancing the benefits of the disclosure with the cost of providing the information. C, yes, for other reason. D, no, the information should be based on what is monitored at one level below the CODM. Oh, sorry, there are more here. There's an E, no, the IASB should not introduce another threshold into IFRS. Companies should apply materiality judgment to determine what to disclose, and F, no, for other reasons.
So I think we may have slowly at least the result of the first vote coming in. And I mean, if I turn to EFRAG, I think you've posed these questions to a few other webinars as well, so you might have something to compare with. I don't know, do you have any immediate reactions on the answer here? Is that what you would expect? I don't know whether dead silence means that you're stunned by the answers.
No, well, we are not so stunned by the answers because, in fact, in EFRAG's comment letter, if we take the first question, we have yes, and then C, in principle, yes, but do completeness, reliability, and ability to provide the information. In practice, the information in many cases will not be particularly useful. And those two answers reflect very well where we are at the moment in EFRAG's responding to the IASB's discussion paper. We think that the disclosures are in principle, in fact, useful, but we are considering whether all these other issues will result in the information, in fact, not in reality, will not be particularly useful. So I think the first results reflect very well where we are in EFRAG, and I will not say that would be a surprise. Then on the second question, of course, that is then a bit different from where EFRAG are. I think, or EFRAG is, I think that at the previous event we had then E, that the IASB should not introduce another threshold, was the majority view in that event. And here it is that the CODM is a pragmatic approach. EFRAG's preliminary view is of course D at the moment, which here in this survey does not seem to get particularly broad support. So there's a bit different than for the first question.
Thank you. I don't know whether you want to comment on the IASB side. I mean, especially the last polling seems to be aligned with the approach you have in the discussion paper, if I'm not fully mistaken. So I guess it would be more or less that you would have expected on those.
As I said, it's something that we wish to check with preparers in the field test. Of course, the board had a discussion about that, and we are aware that setting a different threshold could result in different information to users. So the results the results of the poll in question are interesting. Let's say that. Thank you.
Thank you. We do have another polling question, and that was touched on a little bit earlier in the discussion around the synergies and the sensitivity around that. And hopefully that polling question will appear on the screen in a moment. And while you have the opportunity to answer the polling question, I've received a question on the chat that we can take maybe in the meantime. One of them is saying that goodwill over time will be replaced by own goodwill and therefore will conflict with the constraint to capitalize own goodwill. Amortization will make more sense. What is the view of this in requiring notes about performance while MD&A would be more appropriate? I mean, we do have an issue in the next topic around whether amortize or impair. So probably we'll park that question to that section. But then the other one is, should management be held accountable for divestments? This probably is near to impossible. So what the ones posing the question really want to address is rather whether there's reasonable to monitor management performance on a transaction level. So is it reasonable to monitor management performance on a transaction level? That's a good question, I think.
Well, I may offer a point of view that we learned speaking with some preparers, that sometimes if you look at the original targets for an acquisition, you would conclude that the acquisition in isolation has not been a success. But then over time, you may combine that target differently because the external context, for example, has evolved. So you discovered that there is another source of value in that transaction when combined differently with the rest of the entity. And so you can still say that that is a success, but not measured according to the initial KPIs. So I thought that it was an interesting, practical example.
Thank you. I don't know, Paolo, whether you have anything to add from the IASB side.
Well, here the starting point of the project is more than the monitoring the management's performance is about monitoring the acquisition and give the information to users to assess the stewardship of management. So if I understand correctly the answer, I will say that is slightly out of the scope of the project. The starting point of the project is the investors saying that they do not receive enough information about the business acquisitions. And I don't know if Tom would like to add something on that.
Yeah, a small point. I think Chiara's absolutely right, but there are two things in the proposal that I think are consistent with what Chiara said. One is that we only ask that you track for 2 years. After that, you can stop tracking. You don't have to tell anyone. And so when we think about what Chiara said is how long do you go from your initial projections to these alternatives, which is the point. Ultimately, you're managing the whole of the company, and the acquisition as an acquisition disappears in the mists of time. So we put a limit on how long you have to do this. And we also have a thing that says if you want to change your measures, you can say so because something's changing and we're now going to measure it a slightly different way. You explain that, you say here's a new measure, and you still have this time limit. So I think Chiara is totally right, and I think we put a couple of fail-safes in to be consistent with what she said.
Thank you. I think now we have the results of the two last pollings we had there, especially first the one on synergies. And that might be my tendency as a preparer representative, but it seems like the trend is that either it's not possible because it would be expected to trigger commercial sensitivity, or it may at least in sometimes trigger commercial sensitivity. So the overweight is that there are clearly challenges in providing information about synergies. I think that would be my conclusion.
Yeah.
I can see Jan Peter agrees, and that would also, even with the fact that there are a slight overweight of accountants in the audience, that seems to be the overarching trend. A little bit more complicated, maybe, I think, when you look on question 5. There seems to be a number of the audience that says it's important in the notes, whether that is driven by the audit or whether it's driven by the fact that the location is right. That might be to be discussed, but there's a part of the audience as well saying that it would be difficult and costly to audit this information. But slightly more nuanced, and then there are also a few select people in the audience that essentially say it's not the right location.
I think actually, Kristian, if you look at it, you have around 43% saying that it's important that the information is audited, and I have to say as an auditor, I think that's the reason why they put it there. Then if you look at the responses to B and C, you might actually add them together because B says, no, it's difficult and costly to audit, therefore it should be in the management report. And C says, no, financial statement are not the place to include forward-looking information. And I think that circles around the same thing, that also the information is difficult to audit. So I think they're more or less equally weighted, those two views, whether it should be financial statements or the management report. Which I think is good also given the balance of our audience. Unless you urgently want to comment on this from EFRAG and IASB side, I actually suggest that we move on to the next topic, unless you want to wrap something up on this topic. Because, I mean, the questions here and the answers did wrap up some of the themes we've discussed so far under topic 1. But since you will be handed the floor anyhow now, you have the opportunity to also react on that.
It's Tom. Could I just make one comment, please?
Absolutely, Tom, of course.
Yeah, I think one of the things on audit, and I'll come back to it, is if it's the assumptions that went into the price. There was a binder somewhere with all those assumptions laid out quite clearly. I've seen some background papers to a merger. They're extensive. And notice, again, if what the focus is the assumptions that justified the price, it seems to me that's where I would start my audit. And it'd be interesting to hear from the auditors. To me, this is a critical part of the proposal that makes auditing feasible, that this is not just people sitting there saying, oh, what do you think will happen in the future? This is people saying, we just paid 100 million euros. Here is our background papers. And to me, I think if we start there, the possibility of audit is much stronger than people simply sitting and making comments about the future.
Thank you, Tom. I mean, I do believe you're right in the fact that there will be a binder somewhere, at least with some of the information. But there are a lot of sensitivities around this. But especially when you ask auditors whether they can audit forward-looking information, to a certain extent they say no, but some of the other information should be audible, definitely. Let's move on to the next topic, topic 2, where we go a little bit more into detail with the impairment test. I'll first hand over the floor to IASB.
Thank you. Thank you. Slide 20. So we'll now discuss the other main topic in the discussion paper, the subsequent accounting for goodwill. The board has heard 2 key pieces of feedback from stakeholders about the current impairment test. Firstly, that impairment losses were recognized too late, and investors have often reflected reductions in their valuation long before impairment losses are recognized by companies. And secondly, stakeholders say that impairment test is costly and complex. In response to this feedback, the IASB explored whether it could make the impairment test more effective at recognizing impairment losses on acquired goodwill on a more timely basis. Now we'll take a look at the IASB's work in that area first, and then we'll move to the IASB's preliminary view on its effort to reduce the cost and complexity, and finally, whether to reintroduce amortization. The IASB identified 2 possible reasons for the too late issue: cash flow forecasts that are too optimistic and shielding. On the first issue, IAS 36 requires management to use forecasts that are reasonable and supportable to assess how reasonable assumptions are by examining the causes of differences between the past forecast and actual cash flows, and to base current cash flow projection on assumption consistent with past actual outcomes. In addition, companies are required to disclose information about the assumption made to provide users with information to assess the reliability of the test. The board preliminary view is that if forecasts are too optimistic, this is an implementation issue better dealt with by auditors and regulators than by standard setting. Slide 21, next slide please, explains the second issue which can lead to impairment losses on goodwill not being recognized when stakeholders might think they should be. This is the shielding. Before we start, an important point to mention here is that impairment test is not a direct test of goodwill. Goodwill does not generate cash flows on its own. It can only generate cash flows in combination with groups of other assets, and so can be tested for impairment only with those other assets. Goodwill is therefore tested for impairment in a cash-generating unit or a group of cash-generating units. Hence, the test is an indirect test since goodwill cannot be measured directly. The unit of account for the test is the cash-generating unit. So in this slide, these slides provide a sample illustration of the shielding issue. On the left-hand side of the slide is the acquired business, and an impairment loss will be recognized if it was tested in isolation. However, in this example, the acquired business is integrated into one of the acquirer's existing businesses, and there is significant headroom in that existing business, maybe from internally generated goodwill. Because in this example, the combined business is tested for impairment as a cash-generating unit, no impairment loss is recognized, since, as shown by the right-hand side of the slide, the combined recoverable amount exceeds the combined carrying amount of the assets. The headroom of the existing business is shielding the acquired goodwill from impairment. This example illustrates a too late issue. Shielding occurs in the current impairment test because the reduction in value is first absorbed by the unrecognized headroom. An impairment loss is recognized on the acquired goodwill only if all that headroom has been used up. Moving on to slide 22, the IASB looked at the approach to reduce the shielding effect, incorporating the headroom into the impairment test. This approach compares the recoverable amount to the carrying amount of the recognized assets plus the headroom from the previous impairment test. This prevents the prior period headroom automatically absorbing any reduction in value of the combined business. Any impairment test that results still needs to be allocated between the acquired goodwill and the unrecognized headroom. The approach attempted to allocate at least some of the reduction to the acquired goodwill. However, any allocation will still be imperfect because it's not possible to tell how much of the reduction relates to the acquired goodwill and how much of the reduction relates to the unrecognized headroom, since goodwill is not directly measurable. In addition, the approach will be costly. So the IASB's preliminary view is that it's not feasible to design a different impairment test that is significantly more effective than the current impairment test at a reasonable cost. The IASB accepts that the test is not perfect because goodwill has to be tested with other assets. Some degree of shielding will likely always occur. The test will not always provide a signal of how well the business combination is performing, but this doesn't mean that the test has failed, as some people say. And although cash flows forecasts will always be judgmental, the test, if applied well, should meet its objective of ensuring that the carrying amount of the cash-generating unit as a whole is recoverable. And the disclosure proposed on subsequent performance that we went through earlier should provide better information about the performance of a business combination than the impairment test can. So now, if we can move to the next slide, there is about the other feedback from stakeholders, which was that the impairment test is costly and complex to perform. Hence, the IASB considered whether there were ways of reducing the cost of performing the impairment test without significantly impacting its robustness. One of the reasons given for the cost of the test is the requirement to perform it even when there is no indication of impairment. The IASB's preliminary view is that it should remove the requirement to perform a quantitative test annually. However, companies will still need to assess at each reporting date whether there is an indication of impairment. If such an indication exists, a company will have to perform the quantitative test. This change should reduce costs for companies. However, there are mixed views on the extent of this reduction. And there are also mixed views on the impact that this will have on the robustness of the test. Some believe this introduces further judgment into the test and that not performing the test regularly could result in a decline in the expertise with which companies perform this test. Some also believe an indicator-based test should be introduced only if amortization is reintroduced. This was another preliminary view where the IASB majority was narrow. The majority, however, considered the reduction in cost significant and the reduction in robustness of the test marginal. Performing the test where there is no indication of impairment is unlikely to identify a material impairment and will provide little information to user of financial statements. In addition, performing the test every year cannot solve the shielding issue. Early feedback on the IASB preliminary view and its impact on the robustness of the test is mixed. Although some stakeholders agree with the IASB's preliminary view that it's unlikely that a material impairment could occur without there being an indicator of impairment, some are concerned that companies will find it easier to avoid an impairment if a quantitative test is only performed when there is an indication of impairment. The IASB certainly wants to hear stakeholders' view on this topic, in particular specific examples where stakeholders might consider there to be additional judgment that company must make when assessing for indication of impairment compared to when companies determine assumption for a quantitative impairment test, or whether those judgments made by companies are harder for auditors and enforcers to challenge. With that, I hand it to you. Thank you.
Okay, so I come now to EFRAG's preliminary view. In its draft comment letter, EFRAG states that it shares the IASB reservations on the possibility to develop a different and more effective impairment approach. However, EFRAG believes that there are collateral areas of possible improvements. In particular, EFRAG suggests to address some aspects of the shielding issue, that the guidance on allocation of goodwill to the cash-generating units could be enhanced to improve how the test is applied in practice. EFRAG considers that the guidance could be clarified to help allocate goodwill to the lowest level possible that outweighs costs of impairment testing and information needs based on value relevance. EFRAG also suggests that the IASB could consider enhancing the guidance for reallocation of goodwill. Such guidance is currently driven by changes in the reporting structure, whilst changing in the cash generation should be considered as the basis for the reallocation. Making the strategic rationale of an acquisition more transparent in monitoring the success of an acquisition could help to better structure such tests and better identify triggering events for goodwill impairment testing. On the next slide, we can see that in addition, EFRAG, the draft comment letter includes suggestions for addressing management over-optimism. There are proposed possible disclosure solutions for better transparency of estimations made by management. For these, EFRAG discussed different approaches. There could be a kind of backtesting. The achievement of previous estimations could make over-optimism transparent. The information about assumptions taken to go into the terminal value could be improved. There could be information about the growth rate during the financial budget is used to calculate the recoverable amount. Or as a third option, it was discussed that one option could be to disclose the current level of cash flows or earnings that would allow the users to estimate future cash flows themselves. On the next slide, you can see that EFRAG has therefore addressed several questions to its constituents. So the questions that are addressed to the constituents include the first aspect, what I was discussing. So this is the allocation and reallocation of goodwill, whether that guidance could be improved. And then there is the question whether management over-optimism is best addressed by auditors and regulators and not by changing IFRS standards. The usefulness and practicability of EFRAG suggestions is addressed in the questions to constituents to find out how to address management over-optimism, whether the IASB should consider introducing reversal of impairment in general, and specifically in the case of a recognized impairment in interim financial statements, is one aspect that was discussed as well. This could take some pressure from the impairment testing, and there could be a one-year window, for example, to reverse some of the impairments. On the next slide, you can see the EFRAG's preliminary view in relation to the indicator-only approach. In its draft comment letter, EFRAG concludes that there is a potential to achieve cost savings in adopting an indicator-only approach. However, EFRAG has reservations on the IASB proposal to remove the requirements to perform an annual quantitative impairment test. This is because EFRAG is concerned about the robustness of such tests. An impairment test is a complex process. If companies do not perform an impairment test regularly, their expertise in performing the test is likely to decline. Another concern is management over-optimism. The problem of management being too optimistic could be increased as auditors or regulators have no comparison to impairment tests prepared in previous years. EFRAG for sure notes that there are cases where it is obvious already from the indicator analysis that there is no need for impairment, and as such, the detailed calculation would not add useful information to assess the recoverability of the carrying amount. In these cases, EFRAG believes that an indicator-only approach may play a role, and the IASB could consider elaborating on what is already in paragraph in IAS 36, paragraph 99. An indicator-only approach might, however, result in a lower reliance by users on the results of the impairment test. This could potentially accentuate the too little too late issue and could result in a further loss of information on governance and management stewardship of capital employed. EFRAG would be concerned that this could further reduce the effectiveness of the impairment test and the confidence on the reliability of the test. So therefore, EFRAG requests input from constituents on whether they agree with EFRAG concerns regarding the introduction of the indicator-only approach. And if so, if they have any suggestions about how to mitigate the issue. With that, I would like to give back to you. Thank you.
Thank you very much for this. I think it's interesting to see that again on this topic, of course, there are different nuances, and there's at least some agreement, but there are nuances in what should be the appropriate answer. I'll hand over the floor to Carsten Just Andersen for a comment, and I suppose I could kick that comment off with simply asking the first question, whether you recognize the problem description as outlined by the IASB. And I would say on the first part, whether losses on goodwill are recognized too late, it won't more be a sense of the business community, because I wouldn't expect you as a company to say that in your company it's too late. That's more what you experience from the business community. But in terms of complex and costly for companies, I would assume that you would have a more firm opinion in terms of whether that is a problem description you recognize. So Carsten, the floor is yours.
Thanks. I'm in favor of a simplified approach to how to perform impairment testing, both on how often we are to do it, but also how we conduct the test. It tends to be a rather mathematical, technical exercise performed by specialists, and it is rather time-consuming, and it's hard to explain to other people that are involved in the process, and of course the auditors auditing this area. And also, I find that the results of the impairment test, well, after you have performed all the mathematical exercises, well, you will actually see that it's the parameters you put into the test that actually determines whether the result is okay or not. I think it would be much more valuable if we start focusing on describing the triggering events. That could be if we see a loss on a specific market or certain product category, and discuss that in our annual reports and share these views with the stakeholders. I think that would be much more valuable information. And then also, of course, support that if we somehow could reduce the workload for the preparers, that would also be nice. And then I think if we aim at introducing, or if the goal is to introduce a model that we know, like from intangibles and intangible assets, where we have a similar setup today, if there are indicators, then we should do impairment test. Then it's easy to explain the new model and also easy to implement.
Thank you, Carsten. I'll then hand over the floor to Jan Kristian. And Jan Kristian, maybe you are more in the position to comment also on the problem description on impairment losses on goodwill, whether they are recognized too late, since you come from the regulatory community. So Jan Kristian, do you have a comment or observation on this?
Yes, I would say I'm both a regulator and enforcer, yeah? And I can agree on that it seems like the impairments are coming too late. We have a joke, actually, saying that there's one indicator missing in IAS 36 on impairment, and that is the new CEO. Because you typically see the impairment in the first year with a new CEO. And that could be an indicator that it's been postponed by the future one. But it could also, of course, be because of a new strategy. But there is a tendency on being too late. As a regulator, I would say that the impairment, saying that you should not make an impairment test every year, but only when there's an indicator, I think that would be a good idea, because then you will make a test when it's relevant and not make a test if you have a huge headroom. That's why prepare it then? And I think also that would improve the disclosures on the impairment testing, because you don't have any incentive to make good disclosures if you're just making a test because you should make it. There's a lot of headroom. So I think we're seeing a lot of boilerplate disclosures on the impairment tests, more or less copied from the examples from the big audit firms. I have just one final comment also on the EFRAG regarding the reversal, if that should be a good idea to introduce that as an opportunity. And I think that would be a good idea. But we also remind that we hardly ever see any reversal of impairment on tangible assets, and we have never seen it on intangible assets, even those where you can reverse it. So even if it was a possibility, I think it wouldn't be used. Thank you.
Thank you very much. I think that's actually very interesting. If I may just focus a little bit on the points around the indicators and the triggering events. And I'm trying to push the EFRAG Secretariat a little bit at the moment, because I would like to have the polling question actually around these issues, if we could get that on the screen, because it is important. I think it's an important aspect to figure out, do we want to do it annually, or do we actually want to have triggering events as the frequency to do impairments? So while the polling gets online, and you can launch it if you're ready, I'll hand over first to EFRAG actually, and see what is your reaction on that comment from the preparer side, and then I'll hand over to the IASB afterwards. So if we just start on the topic on the indicators and triggering events.
Well, I understand the perspective of the preparer. What we have learned is that often the impairment test is perceived to be a compliance exercise, which is detached from the management information sometimes. So we perfectly understand the costs attached to that. and we have a lot of sympathy for that. But at the same time, I think our main concern is to solve the issues around the accounting of goodwill, as I was saying at the beginning, the too little too late and the shielding effect, and trying to at least keep some robustness in the test. And what we concluded in our discussions with the technical group, with the board, is that performing every year an explicit calculation of the recoverable amount provides for that robustness. And another thing that we also heard from users is that although if they are not designed to provide input to the calculation of the sum of the parts in terms of the equity value of the company, they still find a lot of useful information in the disclosure around the impairment test when it's done annually. So considering all these points, we concluded that going for an indicator only would not be a good approach, taking into the consideration also the behavioral incentive and the issue of the over-optimism.
Thank you. I mean, while you're talking, we can see some of the polling results coming in, but there's still more to come, but I don't know. I mean, so far there seems to be a majority saying that yes to the polling question. Yes, it would reduce complexity and would allow cost saving for preparers by reducing the frequency.
Yeah, and by introducing this indicator-only approach. I think maybe, Kristian, if I may comment, and you may call this the auditor's hobby horse, but I mean, if you have acknowledged that it's not feasible to design a more effective impairment test to tackle this too little too late problem, then it's, to me, would at least appear a bit counterintuitive then that you should that you would support the IASB going to, or moving to an indicator-only approach for testing impairment of goodwill, rather than then have the annual mandatory impairment test. But as I said, you may well say it's an auditor's hobby horse, and I'm fine with that.
Thank you.
I would be curious to know the percentage of preparers that we have in the audience, because it's it's the second answer that we get that it seems to be a little bit more towards the preparer's perspective. So I don't know if we have.
Yeah, in the audience you have 42% being accountancy profession and only 16 being preparers. So there's more than simply preparers saying this, I have to say, at least if everyone sort of vote based on the composition. And it's going slightly down with the yes point, but I don't know, Tom, whether you want to react or comment. It seems to be following your line of thought.
Paolo, do you want to comment? Or I have a comment too, but...
Yeah, Tom, go ahead, please.
I think this has been kind of the indicators is an interesting one, and everything EFRAG, Chiara said, I think is true. But notice these are all kind of conceptually and expectations, and they're exactly the same expectations I had. I will make two comments on the U.S. experience where they have indicators. Somewhat to my surprise, there is one study that says the people who use indicators are just as likely to impair as the people that don't. Unequivocally, the study comes out with that. Fairly big study, 10,000 companies over whatever, or 10,000 company years. So I say that in that there's also, we can try and get some evidence about this and look at it, because my expectation is exactly what Chiara said. I was a bit surprised, but the study seems solid. The other thing, Duff Phelps do a survey, and the other, with respect to the costs, it's interesting that the other thing in the American experience is the ones that do indicators, the majority appear to do a full-scale quantitative thing every 3 years just to keep their models healthy. It's like turning over the engine almost. And so pragmatically, it would be really interesting to even get feedback on these subtleties. Would the auditors, for example, can you audit indicators, and would you want them every 3 years or whatever to do a full quantitative? I don't know what the answer is. I'm just sharing a couple of American pieces of evidence because they've been running indicators now for a little while.
Thank you. I mean, we do begin to also get some comments in on the chat. And I mean, it might be a little bit in the reverse order because maybe we should start first by talking about how to simplify and whether it's possible to simplify the impairment test as such. But one question or comment that more or less relates to the too little, too late, asking whether preparers may be reluctant to depreciate the value because it cannot be reversed. So essentially, should you introduce the possibility to reverse an impairment, because that way it's not a one-way street. So if a way, would that allow you easier to, or would you take the impairment earlier if you know that you can reverse it? I don't know whether Tom, you or Paolo, you want to answer that one.
I can try to answer on that. I said, I think that by Jan Kristian earlier, it's to be honest, it's an idea as a feedback we received on the outreach from some stakeholders. But as Jan Kristian said earlier, we don't have any evidence about any reversal of intangibles, but we don't have any so far. But we'll investigate if the reversal could provide some relief for preparers. At this point of at this stage of the project, we don't have evidence and arguments on that, on the reversal. But it's something that, as I say, that we received feedback on that.
Thank you. I don't know whether I actually need to ask EFRAG, because I think it's one of the things you've highlighted, but I don't know whether you want to add an extra comment on the reversal issue. And hopefully in a minute you'll get a polling question as well that you're able to answer from the audience. But I don't know whether you want to provide more background around this issue. And while you're thinking on EFRAG, I mean, you also have the possibility to ask questions, and we'll circle back in a few moments to how to improve the impairment.
Well, I think it all came from an effort to identify how to mitigate the behavioral incentive and get the right incentive to the management to be more timely. And then another comment that came on our table was in particular about the impairment in interim reports, or when there are particular situations or very acute periods of stress. So the possibility to do a reversal after was perceived to be appropriate. So there were these two elements.
Thank you. I don't know whether the polling question has been launched. Jan Peter's trying to rigorously to reconnect to the broadcasting version so we can see whether that's been launched. But if it has been launched, I don't know, Rasmus, whether you can tell us the result of the.
It has been launched, yes, and at the moment, 71.4%, the majority say that no, there should not be reintroduced or reversal of impairment losses on goodwill should not be possible, as internally generated goodwill would then be recognized. Now, I can see the percentage is decreasing a bit, but it's still the majority who has that view.
Thank you, Rasmus. I'm just trying to see whether we get some more questions in, but let's go back then to start where we actually started this part of the session in terms of figuring out whether it's possible to improve or make it more efficient in the impairment test. I mean, clearly, as Carsten said, today it's a lot of mathematics, I would say, or calculating, but it's very dependent on the parameters you put in. Are we able actually to get away from that fact that a lot of the dependency in the impairment test is around the parameters or the expectations you have, for instance, in interest rate, etc.? Is it possible to get out of that issue, or can you only disclose your way out of it in terms of being more transparent on what the effect is if you change a little bit in the parameters? Is that, I mean, how do you see that? I don't know whether, Paolo, do you want to?
Sorry, I think I didn't catch the question. Do you mean performing an impairment test that put lower importance to the assumptions of the test?
Yes, exactly. I mean, the assumptions seems to be very important and can, as it was highlighted, more or less change the outcome of an impairment test, some of the assumptions. So an impairment test is essentially very sensitive to that point.
Yeah, but this is not exactly something that the board examined, but the point is that the impairment test should reflect the point of view of the preparer. So it's in the nature of the impairment test that there is some subjective and some judgment. The board explored an headroom approach, where the one I showed earlier in the presentation, but we didn't receive much support from that for that approach. So that's why the board is put it aside and start investigate alternatives to this to reduce the pressure and to try to solve the too little too late problem.
Thank you, Chiara.
Sorry, I had the delay in unmuting. No, just I wanted to share another argument that we considered. Having an indicator-only approach basically switches the focus and put more pressure on the indicators instead of the calculation of the test per se. So it's not necessarily less difficult to have a good and robust list of indicators that are suitable along, 1 year after the other. It's not easy to set a list of indicators and just be satisfied looking at those indicators. So we didn't feel necessarily that all the complexities are gone if we just go for an indicator only. We also heard the suggestion to use the sensitivity analysis as part of this indicators approach, just to see if there is a big headroom, and the sensitivity analysis shows that the key assumptions of the calculations are far from reaching the level of consuming the headroom, then it's reasonable to conclude that you are not in an impairment situation. And I think we have recognized this in our letter when we say that it's not needed to perform when it's obvious that you are not in a situation of impairment.
Thank you. Jan Peter?
Yeah, well, I think if I remember correctly, in the discussion paper, the IASB says that part of this issue about recognizing too little, too late should be explained by providing some further implementation guidance or how actually to perform the impairment test, which has already been indicated that it's burdensome and difficult and complex and so on. So I'm just maybe curious to hear from the audience, and especially, of course, from the preparers, whether you think that more implementation guidance on performing the impairment test, will that be helpful in your work?
I don't know, Carsten or Lone, whether that question was actually more directed to you.
I'm not sure more guidance will assist us in our work on doing our impairment testing. In my view, I think we already have sufficient guidance. It's perhaps more if it could be done more simple, but yeah, I'm not sure how to move forward on that part.
No, and I think you're absolutely right there that there is a lot of guidance already. So I also question whether implementation guidance as such is the answer. But I admit I don't have an alternative to this. But I just think that, and again, you might say I'm riding slightly on my hobby horse, but as an auditor. But if you look at some of the scandals that has been in the world, with companies breaking down with large goodwill balances on large goodwill amounts on the balance, I think on the other hand there is a need to do something without me knowing what it is exactly you have to do, but some of the proposals are here. So I think it's worth considering if you have any ideas to the IASB saying that, well, you could maybe make the impairment test a little bit more easy for us to do as preparers by doing this and that. But anyhow, there is now also a polling question on the screen, asking you whether the IASB's proposed disclosure on the subsequent performance of an acquisition will help to better identify the triggering events for the potential impairment of goodwill. And here we have only 3 options. Yes, the disclosure could help in identifying those triggering events. Yes, such disclosure could help in identifying triggering events, but they should not be required, maybe for confidentiality reason. And no, this would not help as they have been designed for other purposes independently from the book value of goodwill.
So, Jan Peter, I can see a few answers already coming in on that question.
Yes.
More or less a balanced approach at the moment.
We are getting close to a balanced approach, at least for A and B.
So not unexpectedly, I suppose most of the audience would say yes to disclosure.
Yeah.
But the question, I suppose, is more around the balance. Should they be required or not? I do assume that there's a materiality issue somewhere lying underneath it, so it has to be material before it has to be disclosed.
Yes.
Otherwise, I suspect it would violate some of the more fundamental principles. But it seems to be more or less
I think we are
even between two-thirds, but two-thirds are roughly saying that disclosure, mandatory or not, and one-third saying that no, it would not help. Is that so? Does that mirror some of the dilemmas you were facing when preparing the discussion paper and some of the balances you tried to strike? I don't know, Paolo, is that something you can recognize?
Tom, do you want to go on this?
No, you go ahead. If I have anything extra, I'll add it.
Sorry, okay. I was on mute. Well, on the we try to clearly, as you say, that with the discussion paper, we try to find a balance for the CODM approach, for the materiality level. And now linking the topic with the goodwill and impairment, a feedback we received is that the different level at which the goodwill is monitored compared to the CODM approach could be, for example, a trigger for regulators to enforce the allocation of goodwill. So it's a new topic, and we are receiving feedback on that topic, and some of them are very interesting, and we are still examining the possible, let's say, consequences of these new rules if the board decides to go on these directions. In terms of, if I can say something about the indicators that has been raised earlier. The board so far has not discussed the indicators. Arguably, it will do it if it decides to go ahead with an indicator-only approach. And for example, one of the options we heard from stakeholders is that a possible indicator could be, and so requiring a company to perform an impairment test will be a restructure in the allocation of goodwill among cash-generating units, or other kind of indicators for example, missing the targets or the subsequent performance that we discussed earlier. That could be an example of indicators, because clearly the existing indicators in IAS 36 are based on the presumption that the test is performed annually. So there should be some work to do on that.
Thank you. We have received a question. It's directed to the IASB, so it's more or less firing back to you, Paolo, or Tom, it might be. Why did the IASB not suggest allocating goodwill to segments and test at that level rather than at a CGU level, where there is no ability for users to engage with no clear data, compared to segments where there is strong analysis and debate? Would it mean shielding might be larger and make the use of indicators less contentious, difficult to audit? ? So essentially, why not segments instead of CGUs? Tom, I can see you have raised your hand.
Yeah, maybe I'll start and Paolo can add. This is a tough issue, and we have arguments on both sides. Some people, for example, want it to be assigned to they really like the smallest CGU, and they would actually ask us to push harder to make the CGU smaller under the view that you'll have a more precise test of the goodwill and a greater probability that you will catch an impairment quickly. Clearly, if you think about a whole pile of little CGUs, and as you aggregate them, if the company is basically in the black, as you aggregate them, the chance of needing failing an impairment test decreases. And so some people would go that way. I thought that was really interesting when I saw that question come in, because it now flips it a little bit. And while I would accept there's probably a little bit lower probability of an impairment as you aggregate at higher levels, the idea that it would make it easier for users to understand the information they do get at that higher level, that's sort of a reasonable thought. And person should write in because I'd like to think about, we now have a trade-off. And that's why it's so important to have the discussion paper out, as I keep learning more about this issue.
You are on mute.
Yeah. Sorry. Thank you, Tom. I don't know, Paolo, is there anything you want to add, or should we ask EFRAG whether they want to react?
No, nothing from my side. Thank you.
Kathrin, you want to take this one?
The issue is that the shielding effect is larger if you test on a higher level. The question is really what you acquire. If it is the cash generation should be the basis for the impairment testing, and sometimes segment reporting doesn't go together with the cash generation structure, and there could be a good reason to do such impairment testing on another level. Chiara, do you want to add anything?
No, I think you addressed it. This remark goes in the opposite direction compared to our starting point to try to address the shielding.
That's always one of the benefits when you get questions and input that might allow you to learn new things, as also Tom indicated, that you more or less learn something new every time. Not the same as saying that it might change your view at the end of the day, but hopefully we should have another polling question being launched very shortly. Going back to where we began, and really saying it's a way to simplify, if I'm not there. No, it's going to the shielding, and whether we need to do something about that. Is it feasible to design a different test, essentially, is the question all around. It's launched now. I don't know whether there's anyone from EFRAG who wants to sort of get a little bit flesh to the bone of that question. You've touched on it already when you came with the reviews, but maybe just to talk people through it while they're voting. Everyone seems to be voting yes at the moment, but maybe that's just one answer.
Kathrin?
I didn't have the exact wording of the polling question in front of me, but the issue is, would it be possible to design an impairment test at reasonable cost in a way that shielding is better addressed? So there could be a rebuttable presumption that the allocation of goodwill would be one level below the segment level. That would mean that it has not be always on the lower level. There could be a reason given, and then you could explain why it is on the second level to be tested. But to it could be a way to address the shielding effect, because shielding is larger when you test on a higher level.
And if I may add, there was also a suggestion to look at the reallocation of goodwill following a change in the segment reporting structure. And we also suggest that more discipline is put into the reallocation, just to avoid situations where you can have a reallocation that it's done only in order for some goodwill to survive, thanks to the headrooms of the receiving business line, for example. And finally, I think we also suggest that the IASB to look at the guidance when a CGU or part of a CGU is sold, requiring that the goodwill is derecognized in that moment, because now it's done on a conventional basis.
Thank you. I can see a number of answers coming in. Currently, I would say it balances around 57% agreeing with the IASB position and 43% roughly saying that there's room for change, if I may put it that way. So there seems to be a balance here, and definitely not a complete straight answer to this question. I don't know whether you have a reaction, Tom or Paolo.
Paolo, you are on mute.
Sorry. Sorry.
Okay.
Tommy, please go ahead.
I'm going to avoid answering this at the risk of a convoluted, long answer. I think if you really pushed it and you worked hard on headroom, that's probably the best avenue if you really wanted a more rigorous test. And when we put that out there, people did not want that as a solution. And so the people are giving us tough answers here. On the one hand, they're really worried about too little, too late, and they hate the solution to too little, too late. And, you know, we could go into a long debate about all the problems and why they didn't like headroom. And the other ones, and EFRAG made a suggestion also, and nobody was keen on that. Every time we've tried to make it tighter, people basically don't want to go there. And I would be happy, because I can tell you, I worked so hard on goodwill. I know more about goodwill than I believe possible to learn about goodwill before I came to the board. And I really thought about how we might do this. I think actually I'm really keen to look at some of EFRAG's suggestions, but I think they may be small improvements. People will not go and say, oh, too little, too late is fixed. And it's the nature of this test. And I would point out that there are some people, and we say that in the document, who are quite happy with the current test. They would say that as long as the complete set of assets is fully covered by the value in use, let's say, then they're okay. And so there is a subset who understand how the thing works. They're willing to have the signal only when that complete set of assets, the value in use falls below the complete set, and then you hit goodwill first. But to get one that somehow isolates goodwill, which is what you have to do if you want to try and be quicker, then, yeah, if somebody can send one in, because everything we've tried, EFRAG's tried, just hasn't really flown. And that's where we came out with our comment when Paolo was talking, that at a reasonable cost, we couldn't get there. I would personally be delighted to try and get there again, because I find the topic fascinating. On the other hand, I don't think people want to go there with me.
Thank you, Tom. I know it was potentially a little bit difficult question, at least to answer in a short while. We've launched the final polling in under this topic, the issue about the over-optimistic management, if I may put it that way. We seem to get some answers in a little bit balanced around A, B, and D, D being all of the above. So disclosure about actual cash flows and how they differ from management previous cash flow predictions. So the back testing, improved information around the assumptions. But also a number of people seem to say that no, this should not be feasible. So Carsten, could you give me maybe a quick reaction to that?
Sorry, Kristian, one more time. The question was?
It was regarding the polling question. I don't know whether you saw the answers, but essentially a number of people seem to say that improved information around the assumptions around the projected cash flows would be beneficial, but roughly, I suppose, 40% said none of the above. So I don't know whether, is that something you can recognize?
Yes, I agree, but I don't have further comments to it.
Okay, great. Chiara, I don't know whether you want to briefly comment on this before I hand over the floor to IASB to comment on this and bring us to topic 3.
It's interesting to see that there is some support for this proposal, actually. We will consider it.
Thank you. And then I'll hand over to IASB. I don't know whether you first just very briefly want to comment on this. That will be the wrap of topic 2, and then I'll ask you to continue to topic 3.
Oh, yeah, I'll go quickly, a quick comment on that topic. These are some suggestions that we received so far from stakeholders. But as I said during the presentation, and as Tom said earlier, when we try to suggest some improvement to the impairment test, usually we receive pushbacks because the improvements will clearly increase the cost for preparers. But if you want, I don't know if I should go on with the last topic of the session.
Please.
About the reintroduction of reintroduction of amortization. So if we can move to slide 29. Thank you. So in the post-implementation review, several stakeholders say that the IASB should reconsider amortization of goodwill. And since amortization provides a simple mechanism that does target the goodwill directly, the IASB explored whether amortization of goodwill should be reintroduced. In slide 29, we have some arguments for amortization and some of the arguments for the impairment-only approach that stakeholders put forward. The discussion paper contains a fuller discussion of the arguments for both approaches. And here, an important point of clarification, when we are talking about the reintroduction of amortization, this will be with an impairment test as well. I will not go through these arguments. They are on the slide, and I'm sure that most of you are familiar with the reason given by proponents of both sides, given the long history of this topic. So I'll move quickly to the next slide. And here is the IASB preliminary view that it should retain the impairment-only approach. This was on a narrow this decision was made on a narrow majority. The IASB was, like many stakeholders, quite split on this topic. However, this preliminary view reflects the majority view that there is no compelling evidence that changing back to an amortization model will be a significant improvement. This is an this isn't simply about which model is better, but whether there is a compelling evidence that a change is needed. Given the narrow vote of the IASB, the IASB welcomes the feedback on that topic from stakeholders. However, just repeating well-known arguments will not necessarily move the debate forward. Instead, the IASB welcomes feedback that provides new evidence or arguments, or perhaps reasons why previous arguments are now more relevant. And with this, hand it to you. Thank you.
Yes, so EFRAG, the main message from EFRAG is EFRAG has not formed a view and is seeking input from constituents on this question. So there are conceptual arguments, and the conceptual arguments are going in both directions. EFRAG was doing research in the past and was contacting academics to discuss these conceptual questions, but could not find a solution. So it is very difficult to make a decision on a conceptual basis. EFRAG Tech and EFRAG Board were divided, and we have received similar feedback from different jurisdictions that the constituents are divided there as well. If there is no solution from a conceptual point of view, some suggest to find a practical solution. And on this slide, you can see that EFRAG is requesting, therefore, many things from constituents. So the main question is there any new evidence, new arguments for going in one or the other direction? Then in relation to understand a bit what could be a reason to go into one or the other direction, we are requesting whether goodwill is to be seen as a wasting asset or not, whether goodwill is an accounting construct, and from a practical point of view, we try to understand what would happen with the goodwill amortization from a user point of view and from a management point of view. Would it be added back to the profit or loss that would be reported, and what role is amortization have? Then we would like to understand a bit if it would be possible to split goodwill in some components. Some of them could be amortized, some of them could be under the impairment-only approach. And then one of the questions is as well, would it be interesting to get information about the age of goodwill? In relation to the simplifications of the impairment test, we agree mainly with the IASB and address certain aspects in the draft comment letter and ask questions to constituents, especially about the tax, post-tax implications on the impairment testing, and whether they think that there are other cash flows that should be allowed to be included in the value in use calculation. With that, I would like to hand over back to you. Thank you.
Thank you for this introduction. It is an important question, but also a question I think that has been discussed a number of times back in the history. Lone, if I can give the floor to you, and I don't know whether you have a reaction on whether, basically, I suppose, whether to amortize or not, whether you agree with the IASB tentative position.
Yes, yes, of course I have. Well, I like to start by saying, being a preparer of of the annual goodwill impairment test in a company like ISS carrying goodwill in excess of more than 20 billion Danish crowns stemming from more than 500 acquisitions distributed between more than 30 countries. It would, of course, ease my daily life if straight line amortization was introduced, as we clearly use a lot of time and effort in preparing these goodwill impairment tests. It would simplify things for both us as preparers and our auditors, save a lot of time, and perhaps also ensure that potential impairments are recognized, well, at least over time. However, that being said, and I would like to emphasize that I'm speaking from my own point of view and not necessarily on behalf of ISS. I don't believe that going back to straight line amortization will provide an accurate picture of the asset's performance or value. Furthermore, it would not eliminate the need for some kind of impairment assessment and the goodwill impairment test that we know. And I think that issues such as determining the useful life of goodwill would overweight the benefits and also blur the comparability between financial statements. So I support the board's view on retaining the impairment-only model for goodwill rather than reintroducing amortization on goodwill. I believe that the current impairment test, despite it being time-consuming and highly complex, is working as intended, and that the current disclosure requirements provide valuable information on the key assumption applied in the impairment test, including sensitivities on these assumptions on which the user can make their own assessments. And clearly there's also valuable information in a recognized impairment loss compared to systematic amortizations. In ISS, we disclose very detailed information about both the growth and profitability assumption applied on all our material cash generating units. So, but then again, I do see why there may be concerns among users of financial statements that the carrying amounts of goodwill may be overstated, because management may tend to be a little over optimistic when preparing their impairment tests and applying the assumption. Reintroducing amortization is, of course, a simple way for reducing this risk of overstating goodwill. But I don't think that goodwill is a wasting assets with a finite useful life. In fact, at least in ISS, we invest heavily in maintaining what is captured in the goodwill, like know-how and people and talents, etc. And consequently, all other things being equal, I think it's a fair assumption that the value of goodwill do not diminish systematically over time. And finally, the acquisition of a business is normally assumes a going concept premise, and the concept of goodwill amortization is not, in my opinion, in agreement with this premise. So, all in all, I support the board's view to maintain the current impairment-only model. So I don't have any arguments in favor of amortization, but clearly I'm interested in hearing other points of view.
Thank you, Lone. I can tell you that while you talked, we did receive the results of the polling question, and it seems like more or less in total 80% or roughly around that would be in favor of reintroduction of amortization. If I turn to Jan Peter, he may have an auditor's point of view on this.
Yeah, right, Kristian. As I said to you while muted, it is, I think, again, an auditor's hobby horse saying that I think we can agree that there's something not working correctly in this impairment model, because we have seen companies breaking down with a big amount of goodwill on balance. So clearly there is something that needs to be fixed. And amortization, I know it's not conceptually founded argument, but of course amortization will reduce the risk, as also indicated by some of the other respondents here. But again, I also acknowledge that IASB say that we have exhausted all arguments and there are no arguments in favor of amortization. So maybe we just need to look at whether there are other arguments that need to be taken into consideration as well. I say again, it may be an auditor's hobby horse point of view.
Thank you, Jan Peter. Recognizing the time, I don't know, Tom, do you have a reaction to this, and maybe also a closing remark? I know it's a good point, interesting area to close on.
I'll make a couple of comments. As I said, anybody who wants to come and talk to me over a beer, I could talk for hours on this. But I thought EFRAG's comment about could you actually separate out and amortize part and impair part, and I think someone said that, we tried it, and we have twice. They've looked at it, and I think it would be a little bit like the headroom thing, although I'm personally happy to look at it. That, again, people see it as very complex, very costly, and too subjective if we try to actually partition. And the one thing, in talking to people from all over the world, and everyone has strong views on this, what it often boils down to is whether they fundamentally believe that goodwill is a wasting asset or not. And I think Lona was saying she thought it was not, and so she's okay with impairment. If I talk to somebody who's really for amortization, they fundamentally believe it's a wasting asset. And that does go to an instinctive sense of what this is conceptually. And I say that because if I come back to the EFRAG thing, I think one of the problems is the EFRAG comment was correct, is there's elements of goodwill that look wasting, and there's elements of it that look long-lived. And I think that's one of the reasons we just keep circling round and round as we go through this. So again, everybody should write in. We'll look at everything. We'll read everything on it. And then there'll be other factors like, the cost benefit and all those things. And we'll try our best to come up with a solution that'll be a lasting one. But no matter what, there will not be a definitive right answer to this, would be my comment on it.
Thank you. Chiara, any short reactions before we wrap up?
Well, it's interesting to see that it's also important to the group of people that think that the reintroduction of amortization should be considered on the ground of practical reasons. For several reasons, because we are not putting into question with major changes the model, so, and there are components that are wasting, so also without a clear concept behind that. I see that this pool, for example, confirms it from a practical point of view.
Thank you. With this, I think we are close to the end of the session. We've used at least the timing. I was at a certain point concerned about whether we would be able to fill this amount of time. Now it seems that wouldn't be a problem. And as Tom said, we could probably speak for hours.
But we need a beer then.
We would definitely need something then to soften the throat. From our point here in Copenhagen, I would like to really thank you, thank IASB for attending this and providing your insights into a discussion paper. A very warm thanks as well to Chiara and the EFRAG team, you've worked very hard, not only facilitating this in terms of technology, but also the strong technical efforts you put into going through the discussion papers, providing your reactions. And essentially, I would say a lot of the success for many of these events is the fact that we have EFRAG to make their way through the discussion papers so that Tom is not discussing into a vacuum, but having something to discuss with. And then we provide our humble views from preparer sides and other sides to flavor that dish, if I may put it that way. So it really a very warm thank you from our side. Also from here, thank you to the panelists from the Danish preparer side and regulatory side to provide at least some more views than simply looking at Peter and I as moderators. So that would be my closing remarks. A very warm thank you from my side.
And also, of course, encourage that participants, if they have interest, they do comment on the discussion paper, because it is too late to comment if it has moved into an exposure draft, or well, at least it's more difficult to get something changed once it moves into the exposure draft stage. So now is the time to comment if you have any good comments.
Thank you. And while we put the last slide on, which is a forthcoming event for the Danish community, Chiara and Tom, do you want to have a final word?
Well, my final word would be thank you. Thank you to the Danish Confederation of Danish Industry and Danish Auditors for organizing with us this event. Thank you for the IASB for joining forces. Looking forward for your comment letters, and for the preparers, if they want to still participate to the survey, there is still time. Thanks a lot.
Thank you. And Tom?
Yeah, so I think at this point, I'll just echo what Chiara said. Thank you to everyone, especially the participants. Please stay involved and send us. This is the time to speak up and think about the whole package and the interrelationships, and send us your suggestions on whatever parts you think would be useful to us, and we'll do our best. Thank you.
Thank you very much.